Hello and welcome to Fireside Chats on Nomura Podcasts. I'm your host, Jordan Rochester from the Global Markets Research team. And in this episode of our Fireside, we'll be talking with our Asia Economics team with Sonal Varma, Takashi Miwa and Ting on their thoughts for the Asia region in 2021. I'll be asking them what they expect for growth and inflation, what opportunities does the vaccine have and the reopening trend present, and the main risks they'll be watching out for in 2021 as well. Now let's bring in Miwa-san here, our chief Japan economist. Miwa-san, we've had a change in leadership in Japan. We've got Suga-san in charge now. We had the Olympics delayed early this year because of the COVID-19 virus. But what will 2021 bring? Will it be that the Olympics will be on and will we see more fiscal stimulus? What are the sort of Japanese event risks you're looking for?
Right. Flagship policies of Suganomics, like digitalization of the government, as well as comprehensive deregulation, may imply Prime Minister Suga is a libertarian and fiscally hawkish. But we don't think so, as he does not belong to any influential habatsu or political faction within ruling party. He has a good reason to be populistic in terms of fiscal policy in order to get stronger support from ordinary people outside ruling party. So we expect significant and continuous expansion in infrastructure spending, including environment-friendly areas of investments. This is another flagship policy of Suganomics.
Well, 2020 has seen continued yen strength, dollar weakness. This will be a problem for the Bank of Japan, won't it? How are they going to achieve their inflation goal, the inflation target next year? Could we see something different? Could we see rate cuts from the Bank of Japan? Or are there any other policy toolkits that we need to take into account for?
We do not basically expect current strength of Japanese yen against US dollar will trigger any additional easing action by Bank of Japan. This is simply because Bank of Japan has less and less toolkits for additional easing. But in addition to that, the strong Japanese equity market currently is making Bank of Japan relatively relaxed about the level of dollar yen.
So the big question, Miwa-san, is always about what we can learn from Japan itself. We've had record low yields in Japan for a long time. We've had quantitative easing used for a long time. It was one of the first central banks to do so. And when it comes to major central banks, we always look to Japan as the sort of template for what policy actions a central bank could take in the future. What lessons in 2021 should the rest of the world take from Japan's experience? And what sort of impact might that have on the markets in the long run?
The pandemic obviously forced many economies to adopt similar policy mix as Japan has already taken for long years. Unfortunately, the policy hasn't been successful in boosting potential growth as well as the underlying inflation rate here. In this sense, even if the economic condition normalizes in the near future thanks to earlier vaccination against the COVID-19, we should now start thinking about Plan B for the policy mix so that we can overcome a longer run stagnation of economic growth as well as the inflation.
Thank you, Miwa-san.
You're welcome. Yeah, thank you very much.
Okay, we've just spoken about the Japan outlook there, but it's time to talk about China. It's why we need to speak with our chief economist for China, Ting Lu. Now, Ting, the big outperformer this year, especially going into the second half, was China, thanks to a rapid recovery from the COVID-19 lockdowns earlier this year. Do you think next year China will be the global outperformer, or are we seeing signs of a slowdown ahead?
Yes, I do think China will be a outperformer again. So we expect 9% GDP growth next year. And I check consensus forecast for other major economies for next year, and I found that most economists expect US and Europe will grow somewhere around 5%, and Japan will grow maybe somewhere close to 3%. So in this regard, China's 9% growth will be much higher than the rest of the world, than other major economies. Now, of course, my forecast may be slightly above consensus. The consensus may be somewhere around 8%, but anyway, 8% is still way above the consensus forecast for other major economies. Now, so what's the drivers? You just mentioned that in the second half of this year, because of the very successful suppression of COVID-19, and China's been recovering, especially about its manufacturing, especially about China's exports. In November, it's 21% year-over-year growth. So what's behind that? Of course, the first major reason is just about China's very successful containment of the virus. But then it's also about China's very solid manufacturing base. And I think that most likely this strength will extend into next year. Why? Because before the pandemic is over, China will still be a major exporter of this PPE and work from home products. But after the pandemic is over, I think China will benefit from the global recovery. So in this regard, I think China's big market within China and China's very strong manufacturing base will support China's outperformance next year. Then this is also about policy. I believe that for most economies next year, they will have to face some kind of fiscal support in the beginning of the year. Then perhaps maybe some of this fiscal cliff or tightening in the second half next year. Well, I think in the case of China, where we will have some normalization, but because of the exports strength this year, actually the size of stimulus in China is relatively small. So that's why the burden of policy normalization, the burden of deleveraging next year will also be relatively moderate. Then the next reason is about inflation. I think China's inflation will be up from almost zero now, but I don't think inflation is a big problem next year because of a high base, especially because of the high pork price. So low inflation will also provide the Chinese government enough space to only moderately slow down its credit growth. Then finally, I think next year, very likely, we will see some de-escalation of US-China trade tensions because of the Biden's government's policy stance on China would be quite different from Trump's hawkish and inconsistent policy move against China. So these are the major reasons, and hopefully this will answer your question.
Absolutely. So growth will hold up. Inflation will rise, but not be too much of an issue. I agree that there's a global story there about the base effects of this year. We'll get all the inflation Easters out next year, but I think that'll be, I think it's not going to be too much of an issue. Central banks won't get too hawkish. PBOC, would they react to that sort of higher inflation story? Would we see potential for rate hikes to be spoken about next year?
Well, I think at least for the first half of next year, the risk of rate hike in China is extremely small. I think the very simple reason is just about global pandemic. I think before the pandemic is over, I don't think the PBOC will hike interest rates. And there's another concern for the PBOC because they really want to develop China's manufacturing sector, especially for high-end manufacturing. So that's why they really put containing the funding costs for these manufacturers as a priority. That's why I think they will be reluctant to hike rates next year, especially in the first half next year. Well, in the second half next year, it really depends. I still believe the chance is very small. But if in the second half next year, globally, the pandemic is gone, growth recovery is very strong, inflation is up, well, there's some chance, but the chance is quite small. And there's also another concern in the market because, as I mentioned, in China, people focus on year-over-year growth, but then we will have an issue in the first half, especially in the first quarter next year. Year-over-year growth in China will be very high. My forecast is 19% year-over-year. It will be the highest in many years, in about 2 or 3 decades. Then the question in the market is that, will the PBOC hike rates because they see the close to 20% year-over-year GDP growth rate? And my answer is no, because I think PBOC officials knows very well that this is really because of the base effect. Actually, if we adjust for this kind of base effect, annualized sequential growth in China next year will be just somewhere around 5.5%, which will be a pace the PBOC will be comfortable with.
Let's talk about this medium-term to long-term strategy that we've heard a bit about this year, this new dual circulation strategy from China. And what's the aims of that strategy? How is it going to be implemented? And next year, do we expect it to be implemented rapidly? So is this something that's going to happen quickly? Is this a 2021 story?
Well, I think this is a story even for this year. So what's the goal of this is a strategy? Let's just call this DCS. Well, I think there are 2 major goals. The first one is just to be more independent on chips and other high-end manufacturing goods. So China just want to cut its reliance on this kind of products. As you know, this year China was really very kind of, I think it's kind of like angry about the U.S. government's banning of this kind of exports to China. And so China also wished to cut its dependence on food imports and energy imports, and they believe this is of strategic importance. And then we have another goal, is just to cut China's dependence on foreign market, and actually it's just about reducing dependence on exports. So these are 2 major goals. Now regarding how they can achieve it, in the very near term, actually this year we have observed something really important. Actually, it's very important, the change of Chinese government's policy stance. Usually in the easing cycle like this year, the Chinese government will ease many of these restrictions in the property sector and will pump a lot of money to developers. This time it's different. The Chinese government was very, very clear that there will be no such easing, and from August they even tightened funding for developers and for mortgage borrowers. So the purpose here is just about channeling this money and credit from the property markets, which used to consume more than half of China's credit, to manufacturing. Why? Because they just want to make more investment in chips. So that's just actually the short-term policies this year. And actually, we also observe the Chinese government really put a lot of efforts in reforming China's stock markets, and they also build the China's NASDAQ. This is because they want to raise more funds for those high-tech industries in China. So this is the short-term policy. Then for medium to long-term policy, I focus on 3 things. The first one is just about alternative energy. This is extremely important for China, which imports 70% of its crude oil consumption, and China really want to develop other types of energy so they can just rely less on imported crude oil and natural gas. So that's also why they put a lot of efforts on developing those electric vehicles. So this is first one. The second one is just about urbanization. They want to save land, arable land. So they really change their urbanization strategy to focus more these big cities which will save land. The last one is just about saving its money. So they will cut in my view, they will cut those overseas investment, especially those kind of Belt and Road Initiative projects, and instead they will just invest more money within China, especially in manufacturing sector.
Ting, there's also the risks for China from the credit side. You mentioned a few things there. So the housing market remains pretty healthy in China. There's the urbanization strategy you were talking about. What about these recent state-owned enterprise defaults? There's been very few credit event risks this year in most of the developed world, thanks to all the fiscal stimulus and the monetary stimulus and all of that sort of extra help that governments have given to firms via lending programs. But these state-owned enterprise defaults, is that a warning sign of the first big credit event risks to come? Or is there something else that's on your mind?
Well, yes, it's actually has been on my mind since I would say 5 years ago, but especially since about 2 or 3 years ago. I think it will be inevitable. This will happen. If without the coronavirus this year, actually it will even happen earlier. But of course, now the most important question now is that is this really big problem for China? Will this be leading to a credit crunch for China this year or next year? Is this the end of the growth story for China? Well, on the one hand, I'm concerned, I'm cautious. But on the other hand, I have to say that we don't need to be too worried because I believe many of those problems could be solved with high growth and with cautious, prudential approach by the Chinese government. Why? Well, first of all, I think this is really because of the fundamentals. This year, China's growth will be more than 2%, and next year, China's real GDP growth rate will be more than 8%, and my forecast is 9%. With such good fundamental, I believe that China has quite a big capacity to solve the problem. Well, on the other hand, yes, there's a lot of accumulation of debt, but I have to say most of those debt are still domestic debt. So this is in sharp contrast to many EM countries where most of the debt may be foreign debt. But in the case of China, most of debt are domestic debt, and China still has 3.1 trillion FX reserves. Then we have one more positive thing for this year. Well, in the past 2 quarters, in Q2 and Q3, for each quarter, China's current account surplus was more than 100 billion US dollars. So this is amazing number. Actually, this is the highest number since 2008. This kind of very high current account surplus will help the Chinese government to get enough resources in a time when they need to solve the debt problem. When inflation is low, when they have relatively strong currency, when they have a lot of FX reserves and high current account surplus, if there's any problem with those Chinese banks and other financial institutions, the PBOC, the central bank, can play the role of land of last resort, and they can solve the problem. So that's why. So my stance has always been this: it's a big issue. The Chinese government will have to be very cautious, but this is not really the end of the day and the end of the growth story. If the Chinese government can be cautious and focus on the fundamentals on the one hand, but on the other hand, solve those problems cautiously one by one with its deep pocket. And then I think they can survive this kind of issues.
Well, thank you, Ting Lu.
Thank you.
We've just spoken there about China, about Japan. It's now time to talk about the rest of Asia and expand it to the region. And also we'll bring it to India as well. We can't leave India out of this conversation. That's why we have Sonal Varma with me now. So now, what's the outlook like for the rest of Asia next year? The reopening trade is going to capture the attention of a lot of people. But what's the view there for the rest of Asia?
Well, we have a positive outlook for 2021. And we actually think Asia is sort of in a sweet spot Because when we look at the growth trends, in fact, we have an above consensus growth projection for next year. I mean, on the COVID situation, Asia has generally done much better than the developed economies. But of course, the COVID-related risk sort of remains in the near term. But looking further out through the course of 2021, it does look like a number of factors that drive the business cycle are actually falling in place for Asia. One, of course, the vaccinations. We think, between second and third quarter is where we'll see what we call the vaccine pivot point across a number of countries in Asia. The tech cycle, which has been fairly resilient this year, likely to get a lot more broad-based into next year. I think, Asia is home to open economies, and with the global growth outlook looking a lot brighter second half of next year, and China, as Ting mentioned, looking much stronger next year, that should actually be a big positive growth driver as well. I think another factor which is often underappreciated is the role of easy financial conditions, because we have, seen material rate cuts, liquidity easing, etc. But the true impact of that has not been visible in 2020 because there's been a lot of thrift from the private sector. The impact of those easy financial conditions is yet to be actually seen. We think that shows up next year and should be supportive for domestic demand. And finally, I would say the role of uncertainty. 2019 has been a year of trade policy uncertainty, 2020 COVID-related uncertainty. So under a Biden administration, if we do see a reduction in trade policy uncertainty and lower virus uncertainty, I think we're looking at a tremendous amount of pent-up, activity that's going to get released. And I mentioned growth, but sweet spot also comes from the inflation outlook for the region, generally benign, below the central bank's target. And one theme that we think will likely play out is that the monetary policy sort of punch bowl will stay for a lot longer. And I think this combination makes it what we think will be a sweet spot for the region.
Inflation next year is probably one of the risks, because I was just talking about that with Ting Lu. If we have a big pickup in inflation, it's going to drive some narratives early next year about certain central banks pulling back that punch bowl or draining that punch bowl, as you described. In terms of that, in terms of the view for next year, does that mean there'll be some countries that are leaders and laggards in the region, both in terms of growth and perhaps reacting to this inflation story?
Well, on the growth front, for sure, and the factors that lead to sort of, let's say, leaders versus laggards are essentially factors like resilience to COVID-19, how exposed is a country to the tech cycle, what is the political situation in that particular country. Vaccine plans that a country has. So there are a number of factors that are actually going to determine how countries do. So when we look at across the region, other than China, we think South Korea is going to be an outperformer on the growth front. We're fairly positive on Singapore as well. Tech-oriented, huge exposure to the pharmaceutical sector, a good pipeline on the vaccine front because it is a small country. So those countries we are positive on. We also do have an above consensus projection for India in terms of the growth outlook. But on the other side of the spectrum are countries like Thailand, where we do think there's going to be disappointment on the growth front. Of course, very tourism oriented, so it's going to take time for tourism to come back. And the big concern for us really has been the political side with these student protests, which will be a fairly big overhang on domestic demand. And finally, Philippines, we're also a bit more negative on Philippines, mainly because the fiscal side hasn't really given enough of a policy support there. So there are sort of relative divergences to play out.
Well, we need to talk about the biggest economy in the region outside of China. It's, of course, India. What's the view for Indian growth next year, Sonal?
We have a positive view. We think growth will be close to 10% next year. And I think just to put this in context, we've been negative on India through 2019, 2020. So we are turning positive on the cyclical outlook. Many factors to support this. Financial conditions in India have also been materially easier, accommodative. The full impact of that we think will show up in terms of consumption picking up. The government has a reasonable vaccine procurement pipeline, which should be positive on the consumption side. And of course, India will benefit from the global growth cycle picking up as well. I think one thing that though, we are flagging is that while the cyclical view is positive, there are of course challenges that are there. India, entered the COVID shock with very weak balance sheets of banks, companies, fiscal. So those balance sheet challenges are there. And the second challenge for India is really on inflation. It's been quite sticky, and if cost push inflationary pressures pick up, then that could be a problem in 2021. So cyclically growth is looking well, but there are bottlenecks, which basically implies that it's going to be a short cycle, but positive for 2021 for now.
With the COVID-19 crisis, it's been normal to say that we don't expect any rate hikes in developed markets, at least. In emerging markets, are there any chances of rate hikes next year? And what's the outlook for monetary policy? Let's keep it on India to begin with. What's the monetary policy for India whilst we're on that topic? But elsewhere, is there any chance of rate hikes from anyone else?
Sure, Jordan. So, for India specifically, I think, India has been a complete outlier on inflation. The average inflation in 2020 will be close to 7% despite the massive demand destruction. So clearly inflation is going to be a challenge next year. So from the RBI standpoint, though, given the balance sheet challenges and the uncertainty around vaccines, they will take it gradually. We do think the process of normalization will begin, but there will be a sequencing in how this normalization happens. So initially, it's going to be more withdrawal of liquidity in order to move up the short-term rates back to the policy corridor. Then we're going to see some of the regulatory dispensations being allowed to expire. The actual shift in the forward guidance likely to happen only around third quarter potentially. In our baseline, we are building in rate hikes, but in 2022, not in 2021. But the bottom line being that the process of normalization is going to begin. To your other question, Jordan, in terms of the broader view on the region, I think, so from a central bank's perspective, I think broadly it does appear that the risk is that a lot of central banks would prefer to be behind the curve rather than ahead of the curve, purely from a risk mitigation standpoint. You still have output gaps that are negative. Inflation, India is an outlier. Outside India, inflation is actually below target in a lot of countries. And central banks are quite concerned about scarring effects. You have countries like Thailand, which are quite worried about the risk of currency appreciation and its adverse impact on growth and inflations. And of course, there is vaccine uncertainty in the first half of the year. So I think at least, for the next 6 months, it does look like it's more neutral on the policy front. In fact, some of the countries in ASEAN are still fighting the virus wave. So for Philippines, Thailand, Malaysia, we in fact think the risk is towards rate cuts, most likely to be delivered by the end of first quarter this year. But I think, you do raise an important question, and if we do see the kind of growth recovery that we think will play out, the big challenge for central banks will be the risk around financial stability and the pickup we are seeing in housing prices, for instance. So there will come a point, we think, sometime in the second half where the discussions around normalization should start to begin. We don't have any country hiking rates in 2021, Jordan, but I think second half, the risk of at least some guidance towards normalization and exit should begin in many more countries.
Absolutely. I think that's kind of one of the reasons perhaps the Fed's adopted average inflation targeting. So to avoid that knee-jerk reaction from central banks to that one-off inflation shock that from the base effects next year. Well, thank you, Sonal, for all of that.
Thank you, Jordan.
So those are the views from us, those are the trades from us, and that's the Fireside. Thank you for listening into the podcast. If you enjoyed listening to the show or want to hear more from Nomura's economists, researchers, and investors, please like and subscribe to Nomura's podcast on Apple, Spotify, and SoundCloud, or wherever you do get your fill of podcasts. If you're feeling generous, please do leave a review on your podcast store of choice, preferably a nice one, and please do log on to NomuraConnects.com to keep up to date and keep on listening. Thanks, goodbye for now, and stay safe.